the CEO of the Nigerian Stock Exchange, Mr. Oscar Onyema, Mr. Lanre Osibona, the Senior Special Assistant to the President on ICT, distinguished ladies and gentlemen, good morning. Thank you. Please permit me to stand on the already established protocol. It's a great pleasure to be here with you at the 2018 NSE Market Data Workshop. Let me thank again the CEO of the Stock Exchange, Mr. Oscar Onyema, for inviting me to give this keynote address. I'm also delighted to be in your midst to speak on the topic, digitization, disruption, and financial inclusion, which can also mean digital finance as an essential tool for enhancing financial inclusion. That's the way I understand the theme of today's workshop. As the great Mexican writer Carlos Fuentes once said, culture consists of connections, not separations. I make bold to add that a great culture also consists of inclusion. SEC, together with the CBN and other sister regulatory agencies, have made important contributions to the progress of financial inclusion through valuable guidance and active involvement in the national financial strategy aimed at reducing adult exclusion from financial services to 20% by 2020. Thanks to these collaborative efforts and also to strong national commitments, financial inclusion is advancing in Nigeria. Between 2012, when the NFS was launched, and now, various initiatives and sensitization programs have been and are being implemented. According to the World Bank's Global Financial Inclusion, Global FinDex, about 2 billion individuals and 200 million businesses remain excluded from the financial system, more than 40% of the world's adults. Most of these people live primarily in developing countries and in rural areas. Women remain underrepresented in the financial system with a 9% gender gap in developing countries. For micro, small, and medium enterprises, who account for more than 90% of global enterprises and provide close to 50% of all formal jobs in developing economies, approximately 40% of those do not have access to financial services. Yet, they need to grow, succeed, and employ more people. What is also worthy of mention is that financial exclusion is a universal issue, so it's not just a Nigerian thing. Within the EU alone, 58 million people do not have access to a basic bank account. According to Alliance for Financial Inclusion, they note that in the US, 7% of households are totally unbanked, and that is about 16 million adults. Between 2010 to 2017, about 1.2 billion people gained access to an account for the first time in their life. Much of the progress is related to the impact of financial technology. Although the challenge of financial inclusion is significant, we have a variety of powerful tools to drive progress. Among the most promising is digital finance. Today, I would like to share my thoughts in 6 key areas. The first is why financial inclusion is important, especially for women and the unserved, the dynamics of digital finance, the intrinsic benefits of digitalization in today's financial sector, the disruptive nature of digitization of finance, the future of fintech for financial inclusion, the Bali fintech agenda, the nexus between digital finance and financial inclusion, the essential role of digital finance in enhancing financial inclusion. On financial inclusion, the question I would like to ask, what have we learned so far? Why is financial inclusion important, especially for women and the unserved? Financial inclusion is distinctively moving up the reform agenda, both in individual countries and globally. To date, more than 60 governments across the world have set financial inclusion as a formal target and squarely as a key objective. It is also part of the United Nations Sustainable Development Goals. Financial inclusion helps people become financially independent and economically self-sufficient. It helps the underserved population increase their productivity and incomes. The World Bank, for example, has set a goal of ensuring universal access to financial services by 2020. This subject has gained prominence as a global policy agenda as it complements other policy initiatives on reducing poverty, addressing inequality, and promoting financial stability and integrity. As you all know, the Hamburg Action Plan set out the G20's strategy for achieving strong, sustainable, balanced, and inclusive growth. Not surprisingly, the third priority action of the Hamburg Action Plan is to promote financial inclusion. This buttresses the critical role financial inclusion plays in global development. A financially included society will provide increased access to finance, which is what is giving a lot of headache right now. Access to finance can encourage investment in new and more productive technologies. It can also help them expand in terms of size and complexity of operations. There is also an important gender dimension involved in financial inclusion. In March 2018, the IMF published a study on Nigeria showing that reducing gender inequality could increase real GDP growth by an average of 1.25% annually. Similarly, an IMF staff research investigated the forces that propel access to financial services for women. The findings show that women who live in countries with stronger protection against harassment are more likely to open a bank account, borrow, and save, and make greater use of financial services such as mobile payments. Financial access for the average woman living in an emerging market or developing country is almost 16% deeper. That is, financial inclusion scores are higher. This can be achieved by overcoming challenges related to reach, customer information, and commercial viability, and by improving infrastructure. Examples include expanding access to finance while reducing costs, providing new ways to raise funding, enabling new information services to assess risk, and spurring new businesses. Secondly, adopting regulatory framework and supervisory practices for orderly development and stability of the financial system. This will help facilitate the safe entry of new products, activities, and intermediaries, sustain trust and confidence, and adequately respond to risk. At the SEC, we have set up an assessment form with a view to developing a regulatory sandbox that will offer a safe space where startups and other businesses can test innovative products, services, business models, and delivery mechanisms relating to the capital market in a live environment without immediately satisfying all the necessary regulatory requirements. This way, we are ensuring that regulation is made in such a way that it does not stand in the way of innovation and its overarching benefit of developing the Nigerian capital market. If I didn't hear anything in Bali, one of the things I heard and is stuck is that the regulator is an enabler. So we are here to enable the fintech industry to grow and also bring more growth to the system. Lastly, safeguarding the integrity of financial systems. This may be achieved by identifying, understanding, assessing, and mitigating the risk of criminal misuse of fintech. Country responses have varied considerably, but in all cases, it is important to strengthen anti-money laundering, countering financing of terrorism. compliance and monitoring by using technology to support regulatory compliance and supervision, there's a need to ensure that financial inclusion policies are in line with the traditional mandates of financial regulation, stability, and integrity of the financial system and consumer protection. What then is the nexus between digital finance and financial inclusion? The essential role of digital finance in enhancing financial inclusion is that the use of digital tools creates potential to make financial services available to a wider range of consumers and enterprises, promoting financial inclusion and the affordability of financial services. The major setback many experts have cited as the bane of financial inclusion in Nigeria is the apparent distrust for financial service institutions and low literacy levels among Nigerians. Credit must be given to the Federal Ministry of Finance and the Central Bank of Nigeria for measures they have put in place to raise the bar on financial literacy in the country as a panacea to driving financial inclusion. So what else needs to be done? One element that readily comes to mind is innovation and technology. This perhaps must be why many commercial banks have been remodeling their operational strategies to focus more on digitization and mobile solutions rather than on branch network expansion. According to a 2016 McKinsey Global Institute report, digital finance could boost the GDP of emerging economies by 3.7 trillion by 2025 and benefit numerous stakeholders. Equity crowdfunding portals are disrupting the venture capital market by enabling investments directly into private company startups, and peer-to-peer lending platforms are disrupting the banking market by facilitating lending to small and medium-sized enterprises. The growth potential is tremendous. Goldman Sachs' 2015 report entitled Socialization of Finance called crowdfunding potentially the most disruption of all the new models of finance. The World Bank estimates that crowdfunding investments in developing countries alone could reach $96 billion a year by 2025. According to the World Bank, the market potential in Africa for crowdfunding would reach $2.5 billion by 2025. As conditions for accessing finance are deemed too stringent for many startups, the necessity for equity-based crowdfunding in Nigeria is growing immensely. It provides a cheaper alternative source of financing, which obviates the need to provide collateral security. Looking ahead, technologies like APIs and blockchain can enable the development of new modes of recording and sharing data across various business value chains, thereby reducing information asymmetries. Fintech is opening the door to new mechanisms for companies, including SMEs, to raise funding directly from investors, such as crowdfunding and marketplace lending. In tandem, it is supporting the development of key information services that allow investors to assess the risk of their investment, such as credit scoring or credit rating mechanisms. It's also creating new channels for distribution of capital market products, such as mutual fund supermarkets. At the same time, it's allowing customers to access other support services, such as investment advice, popularly called robo-advice services, at a lower cost. As of 2017, 80% of adults in India had an account. Female bank agents with mobile devices in open-air markets in Nigeria are also scaling up potentials. In this case, women are enabled through a tiered KYC system to set up accounts without documentation or minimum balance requirements, and to make deposits and withdrawals without having to leave their stalls. Think of a cocoa farming cooperative society in Sikoloba, in Ondo State, that sells cocoa at the highest price to an industrialist in Amsterdam, Netherlands, without any middleman or intermediaries. Digital channels deployed by banks, telecom companies, and other providers have enabled millions of people with mobile phones to access digital finance over recent years and have connected them to not just payment services, but also to savings, insurance, investment, and credit. Moreover, mobile money has enabled access to essential services like water and electricity through pay-as-you-go services. I can't remember when the last time I went to PHCN to go and buy light. I just sit with my phone. I buy my light. Excessive KYC requirements can hinder financial inclusion, as providers might find it too onerous to deal with the less privileged or financial illiterate. The ideal method is to design KYC due diligence regime that is adequate to the task of maintaining financial integrity, yet do not create unnecessary barriers to financial inclusion. A carefully implemented risk-based approach has to be adopted in achieving financial integrity for a fully financial inclusive market. Less burdensome KYC rules for basic accounts for low-income customers. Consider, for example, a vulcanizer who has a vulcanizer's union ID card and possibly belongs to a thrift society. The details from the cooperative society could be used as a base information level to render certain financial services to the vulcanizer, but the banks will not do that. Partnership is critical in promoting financial inclusion. This partnership should also include investors, policymakers, and fintechs. If we must reap the full benefits of fintech, cooperation is key. No one can do it alone. Some countries are establishing a forum or task force for public and private sector players to jointly explore leveraging fintech for financial inclusion. We are no different in the Nigerian capital market. At the second quarter Capital Markets Committee meeting of 2018 in August, we constituted a market-wide fintech committee to develop a roadmap for fintech in the Nigerian capital market. So for us to fully harness the power of technology and digital finance to drive financial inclusion in a safe and responsible way, we must adopt a customer-centric approach that puts client needs at the center of our activities. Hard-to-reach segments, such as women, small-scale farmers, and micro-small enterprises can benefit in particular from digital financial products that are tailored to their mode of operation. Secondly, we need to better prepare and empower customers, particularly low-income earners that may not be digitally literate. We can leverage technology to increase their financial skills by designing online programs or developing applications or voice messages that can help low-income farmers better manage their finances. I would like to conclude that I could not help but notice that the core values of the NSA are captured in the eye-catching acronym AIF. It's ambition, inclusive, and fair, which help brand, amongst others, the many advantages of Nigeria as an investment destination to the world. It suggests that the NSE is poised to contribute to and share even more insight in the collaborative quest to make the Nigerian economy a financially inclusive one. Ladies and gentlemen, despite the clear evidence of its benefits to individuals and society as a whole, financial inclusion is often proceeding on an isolated track, more social approach than digitized. It is critical that we avoid such a silo mentality. Financial inclusion is an integral part of inclusive growth strategies and should be closely integrated into macroeconomic and financial policies using digitized finance mechanisms. When financial systems become more inclusive, they help broaden financial markets and make policies more effective. By bringing more sections of the population into the formal sector, the effects of market deepening initiatives are better expanded. We have tried in our efforts, but significant work is needed to assist the almost 2 billion people and over 200 million businesses that remains financially excluded. At the end of the day, when our economy is more inclusive, the gains are less elusive. The market would be deeper, vibrant, more effective, and create a better future for everyone. I enjoin us all to be more committed to this agenda. It is time to make all the difference and make it a reality. Thank you for listening.